students, we start today with revision for ESOP, Advanced Accounts, chapter carrying weightage around 6 marks, approximately 6 to 10 marks, depending upon the length of the question. Now, what is ESOP first of all? It's a short form, students. ESOP is Employee Stock Option Plan. Shortly called as ESOP. Stock means shares here. Option is another synonym for it. This is a kind of a staff welfare benefit, you can say. Employee benefit expense. You are the company, your equity shares are having face value 10. At present, the market value going on is 130. Under ESOP scheme or ESOP plan, you are offering to your employees, subject to certain conditions depending on the employment agreement. The dear employees, we will issue you our company shares of 10 at 130. So shares will be issued at market price. So 130 can also be called as issue price. That means the company will issue shares at a premium of 120. Employees will say, sir, what is benefit to us in that? Company will say, the dear employees, we will issue you shares of 10 at 130, but we will collect from you only 40. So this ESOP, these shares are offered to you, the offer price is only rupees 40. What does this mean? Company giving shares at 130 but collecting from employees only 40 means company itself will bear remaining 90 as an expense, and this 90 expense shouldered by the company is called as employee compensation expense. So issue price and face value difference is securities premium. Issue price and offer price difference is employee compensation expense. Just try to understand some technical terms. Suppose your company offers 1000 shares, 1000 options. This offer price is also called as option price. Suppose your company offered 1000 options. So I can write here total options offered is 1000. Suppose the scheme starts, the offer is given on 1/4/2020. The company will offer the shares to employees saying that this is the ESOP scheme now applicable, and employees, we are giving you 8 months time to decide. And this scheme is applicable for 8 months. So from 1st April, May, June, July, August, September, October and November. So this scheme will expire on 30th November. This time period allowed to employees to think whether you want to participate in that or not. This time period is technically called as vesting period. Now after 8 months, the employees during these 8 months must have responded. In a simple language, I can say at the end of 8 months, the answer can be either yes or no. Presuming out of this 1000 options, some employees whose options were 200, they said, no sir, we are not interested. We don't want to go for this. That means for them, the scheme will get closed. Our company will not think of them that we have to allot them 200 shares, etc. No, they denied. So that is called as unvested options lapsed. Lapse means now the scheme is not applicable to them. It's of no use to them. What does this mean? Other 800 said yes. Yes, we are interested. We will like to purchase the shares from the company under ESOP scheme. This 800 who said yes can simply called as vested options. Now, the company, the company, will focus on those 800 vested options, and they will be given some time. Said okay, on 800 shares, the offer price is 40. So kindly start paying to the company by this time. Vesting period ended on 30th November. So now, suppose our company is offering them 2 months. So this vested options are given 2 months, say from 1st December 20 to 31st January 21. It kindly pay us money so that we can allot you shares. This time period allotted to them, this is called as exercise period. So the vesting period ends, the exercise period will start, students. At the end of exercise period, again there are chances of 2 outcomes. What are the 2 outcomes now? Those who said yes, vested option, 800, may be possible after 2 months they are not able to arrange for the funds, or maybe they have a better priority, some other priority, some medical emergency, education for children, so on and so forth. So after saying yes, when money payment comes, that okay, you pay the money, further 100 say no, we will not be able to pay the money, kindly cancel our name. This 100 will also lapse. Your company have not to issue or allot any shares to these people. This will be called as vested options lapse. Previous one was unvested options lapse. This is vested options lapse. That means out of 800, 100 said no. That means other 700 said yes. Okay, we are ready to pay, and this is our money, we are paying you. So those people who paid money to your company, this 700 is called as vested options exercise. The different terminologies: total options, then unvested option lapsed, vested option, after vested option lapsed, and vested options exercise. 2 time period, 1 vesting period, and second exercise period. Now, how do you do the accounting for that in your company's books? The accounting will depend upon 2 situations: whether the scheme, the vesting period, is within 12 months or more than 12 months. In our question, what I had shown you, definitely vesting period is only 8 months, within 12 months. So situation A, case A, where vesting period is within accounting year. So where vesting period is less than 1 year. Within 1 year, the scheme lapsed, scheme over, finished. Simply we have to pass 2 entries. Entry number 1 for vested options exercise. Your company has allotted how many shares? 700 shares. Offer price was 40, face value was 10, and 130 was the issue price. Just think of the entry. For your company, money is coming in. So debit what comes in? Bank account, debit. On 700 options, offer price was 40. The company will receive 28,000 rupees. Then, how much expense your company had? Company had to suffer 90 rupees per option and 700 options company is issuing. So company had expense of 700 into 90. This expense is called as employee compensation expense account debit. 700 into 90. So that will be 63 now. 2. Our company is allotting them shares. It's an issue of shares. 2 equity share capital always with a face value. 700 into 10. 7,000. And last one. 2. The shares are issued at premium of 120. We discussed. So 2 security premium. 700 into 120 is 84. The first entry, the only entry precisely, friends, when your accounting period ends within 1 year, is vested option exercise. And second, which you know right from your 11th standard of accountancy, the rules of nominal account, that at the year end, all nominal accounts should get closed and they should be transferred to profit and loss account. In our journal entry, the nominal account is this one, employee compensation expense. So now at the year end, this employee compensation expense should be transferred to, debited to profit and loss account. So my second entry is simple, transfer to P&L. My entry will be P&L account debit, profit and loss account debit to employee compensation expense account. Come on, what was our expense in the previous entry? Employee compensation expense was debited by what amount? 63,000. So here, transfer to P&L will also. So this was case A, situation A, when the vesting period is less than 12. A question can come, sir, if it is more than 12 months, what to do? Simple logic. Suppose vesting period is 3 years, suppose I am saying. Then your expense, in our sum expense was 90 rupees. That 90 rupees expense will be spreaded over a period of 3 years. Accrual concept you can say. So every year you will debit to profit and loss account 30 rupees. So situation B, if vesting period is more than 1 year, in that case, what entry shall we pass? I told you the expense has to be bifurcated, allocated over the period, the vesting period. The journal entries under this situation can be like this. Entry number 1, for the proportionate expense of the current year. So what is proportionate expense? At the rate of 30 for 1 year. So that entry we should pass for proportionate expense when your company is offering the option. Entry will be employee compensation expense account debit to ESOP outstanding account. Simple. Next, Out of this, suppose, and of course all of you know friends, this is the expense which is to be transferred to P&L account at the year end. So my second entry will be profit and loss account debit to employee compensation expense. Third entry which I am discussing now. Suppose some of those people who denied, no sir, we don't want lapses. Then what should be the entry for lapses? Simple. This was the entry for offering shares to them. If it is lapses, it has to be reverse entry for the lapse. Entry will be ESOP outstanding account debit to employee compensation expense account. This is for lapses, the reverse entry. And now the last one, for those people who will pay you money, vested option exercise. Entry, money is coming in, so bank account debit. The change coming here, at the time of offering them, we have credited ESOP outstanding. Here it is. Now we are completing our promise. We are allotting them shares. So ESOP outstanding should get closed. The one which was credited in the first entry will now be debited. So ESOP outstanding account debit to, we are allotting them shares. We are issuing them shares. So to equity share capital with the face value, and to securities premium if the shares are issued at. So if vesting period is 1 year, only 2 entries. If it is more than 1 year, every year we have to pass this entry. Not to forget, whenever there is a lapse, the entry will reverse. Not much more to remember in this topic. This entries and simple calculation to be done every time. I am solving one sum with you people to make you understand and how the calculation will be done and how entries can be passed for the ESOP part. Okay, typical the working note has to be taken care of here. What I am solving a typical sum, that working note will be clear to you people, and what journal entries we pass also will try to clear. Okay, let us start with a practical sum. We take a question to understand the ESOP accounting. Question number 6 in your textbook. Choice Limited grants 100 stock options to each of its 1000 employees. 100 options, and per option 1000 employees. 1000 into 100. Total our company is offering 1 lakh options on 1/4/14 for rupees 20. So offer price is 20. Depending upon the employees at the time of vesting of the options. Option would be exercisable within a year it is vested. So exercise period is 1 year. Market price of the share is 50. Look at the offer price is 50. Market price is 50 and it is offered at 20. That means your company is incurring employee compensation expense of rupees 30 per option per share. The option will vest at the end of year 1 if earning of choice limited is 16%. So company is putting some condition. And if our profitability in the first year is 16%, then vesting period is 1 year. If not, vesting period will be 2 years. What is the condition then? Or it will vest at the end of year 2 if average earning of 2 years is 13%. And still if it fails in the second year, then, or lastly it will vest at the end of third year if average earning of 3 years will be 10%. 5000 unvested options lapsed on 31st March 15. So first year 5000 options lapsed out of 1 lakh 5000 rejection. So we are expecting expenditure on 95,000 options in the first year. What about second year? 4000 options lapsed. In the second year, 95 minus 4, 91,000 expected vested options. And last year, 3,500. So 91,000 minus 3,500 is 87,500. Options we are likely to vest in the third year. Following is earning of choice limited. 31st March 15, 16 and 17. The percentage of earning is 14%, 10% and 7%. 850 employees exercise their vested options. 850 employees. Per employee 100. What does this mean? 85,000 vested options exercise. Last year left was 87,500. 85,000 they paid you money and you allotted them shares. What does it mean? Remaining 2,500 will be vested options lapsed. Remaining options were unexercised. What will the remaining options? That will be 2,500 options, vested options lapsed. Past journal entries for the above. Our first job, students, here will be to prepare a typical working note to find out that under this situation what are our expenses in year 1, year 2 and year 3. Year 1 ending on 31st March 15, then 31st March 16 and then 31st March 17. A table, a working note like this has to be prepared by you. Particulars 31st March 15 first year, 31st March 16 second year and 31st March 17 third year. First one, expected vested options. Of course, in the first year, expected vested options were 95,000. How you got 95,000? 1 lakh minus 5,000. So expected vested options were 95,000 in the first year. Your company is expecting that 95,000 shares we will have to allot because 5,000 is already denied. 1 lakh minus 5,000 is 95,000. Per share our expenditure is 30. So 95,000. Total expense on vested options is 30. So 95,000 into 30 will be rupees 28 lakh 50,000. Now confirm whether we condition satisfied in the first year or not. What was the condition? That profitability in the first year should be 16%, but no, first year profitability is 14%. What does this mean? At the end of first year, you are sure that vesting period cannot be 1 year. It is minimum 2 years. So this 28 lakh 50,000 is your expense for a period of 2 years, and we are in the first year out of this 2 years expectation. So 28 lakh 50,000 is expense for 2 years. Then how much for the first year? Definitely half. So expense till the end of current year will be how much? 28 lakh 50,000 is for 2 years. I want for 1 year, so 1 by 2. 14 lakh 25. First year. So next line says, is anything already debited to P&L account last year? No, this is the first year adoption. That means in the first year, I should debit employee compensation expense amounting to 14 lakh 25,000 in the first year. Let's go to the second year. Out of 95,000, still 4,000 lapses. So now it is 91,000. 91,000 into 30. So my total expense now will be 27 lakh 30,000. Confirm. Is condition satisfied in the second year? What was the second condition? That at the end of 2 years, average should be how much? 13%. Confirm. First year 14 plus 10, second year 14 plus 10, 24 by 2, 12%. Requirement was 13%. What does this mean? Vesting period will not be 2 years, vesting period will be 3 years. So this 27 lakh 30,000 is expense for 3 years, but I am in the second year. So for 3 years it is 27 lakh 30,000. Then for up to 2 years, it will be how much? It will be 27,30,000 into 2 by 3. What is my 27,30,000 into 2 by 3? Expenditure till the end of second year is 18,20,000. For 2 years, my expense is 18,20,000, but out of 1820, in the first year, I have already debited to P&L account how much? 14,25,000. So now, how much shall I debit in the second year? Is remaining 3,95,000. Third year, question says further 3,500 lapses. So 91,000 minus 3,500. This will be 87,500 multiplied by 30. So my expenditure will be 26,25,000. Confirm. Have we satisfied the condition in the third year? Condition was average of 3 years should be 10%. 14 plus 10, 24 plus 7, 31. 31 divided by 3, 10.33333 infinitely. Requirement was 10, ours is 10.33. So yes, vesting period is finalized now, 3 years. This 26,25,000 is for 3 years and we are in the third year. So total expense till third year should be 26,25,000. Out of 26,25,000, which is third year, total expense of 3 years. First 2 years we have already debited to P&L account. How much? First year 14,25,000, second year 395. That means amount already debited to P&L is 18,20,000. 3 years total expenses 26,25,000. Up to third year means first year and second year 18,20,000 is already debited. So now how much shall I debit? I should debit now to P&L account 8,05,000. So all the 3 years, 2 entries each. First 2 entries by 1425, other 2 entries 395 and then 8,05,000. I'm just showing you the journal entries also so that you can revise it very easily and very faster. First year end is what? 31st March 15. So 31st March 15. End of first year. My entry will be employee compensation expense account debit to ESOP outstanding account. How much was my expense to be debited in first year? 14,25,000. Second entry at the year end, 31st March 16. Transferring the expense to P&L. So my entry will be P&L account debit to employee compensation expense account. 14,25,000. This was first year. 31st March 15. I'm sorry, not 16. 31st March 15. Same 2 entries on 31st March 16. What is my same entries? Employee compensation expense account debit to ESOP outstanding. By what amount? 3,95,000. Second entry on 31st March 16. P&L account debit to employee compensation expense account. What amount? 3,95,000. Second year. Third year also, same 2 entries for the year ended 31st March 17. First entry, employee compensation expense account debit to ESOP outstanding, 8,05,000. Second entry, transferring it to P&L. P&L account debit to employee compensation expense account, 8,05,000. Vesting period over, 6 entries completed. Now we are entering into exercise period. What is question telling you? 850 employees exercised their options. Vesting period completed, exercise period is 1 year. So after 31st March 17, my exercise period will be 1/4. Confirm. Is the date given anywhere? No. They have used the word within a year. So I'll simply write down 1/4/17 to 31st March 18. In this year, 850 employees, per employee 100, 85,000 vested options exercise. Entry, money is coming in, bank account debit, bank account debit by how much amount? 85,000 options multiplied by offer price was 20. So 85,000 multiplied by 20. So amount received will be 17 lakhs. Then, as usual, ESOP outstanding account debit with the expenditure 85,000 into 30. That is 25 lakhs 50,000. 2. Our company is issuing shares. So 2 equity share capital account, always with the face value. 85,000 into 10, 8 lakh 50,000. And 2, it is issued at 50, face value 10. So 40 rupees is premium. So 2, securities premium account. 85,000 into 40. 31. Of course, you should write narrations also in exams. Like here, narration will be being entry passed for 85,000 vested options exercise. And at the end of 1 year of exercise period, when it is over, that is on 31st March 18, out of 87,500, 85,000 options, we got the money. Remaining 2,500 vested options will lapse. Entry for lapse is always a reverse entry. Entry will be ESOP outstanding account debit. How much? 2,500 options into 30 or expenditure 75,000. 2. Take care. I cannot write the word to employee compensation expense. Why? Because in first 3 years, 31st March 15, 16 and 17, this employee compensation expense is already debited to P&L account. You've seen the entry. Now it is already debited to P&L. So now it should be credited. So you can credit general reserve account 75. Being entry passed for 2,500 unvested options. Most important part was that typical working note, this working note. Once this working note is correct, entries will not pose any problem for you. This is one of the standard example of ESOP, which you can very well expect in exams, whereby you have to make a table allocating expenses over a period of vesting period, trying to find out how much should be debited every year, also trying to find out how much is debited already in past, so that remaining part only I will debit it in the current. What is the standard example? A day before exam, you can very well refer to this. Of course, I like to discuss with you to show you one extra question which is there in our homework section. Is this one. Question number 9. I can just show you that if this kind of question is there, how simple is your working note. Read the question. Question number 9. Homework section of our textbook. Ajanta grants 120 shares options to each of its 460 employees. There are 460 employees. Each employee is given 120 options. Each grant is conditional on the employee working for Ajanta for next 3 years. Company is putting condition that ESOP facility will be there to you when you work in our company for 3 years. Ajanta has estimated that fair value of each share option is 12. Means employee compensation expense for one share, one option is 12 for your company. Ajanta estimates that 25% of employees will leave during 3-year period. Come on friends, if 25% will leave, what does it mean? Your expected expenditure will be on 75% only. And so, forfeit the right, forfeit means lapse, the right to share options. Everything turns out as expected. Really, in reality also what management expected, 25% employees left. And once they leave, they will not be entitled for ESOP. We will not be allotting them shares under ESOP because they violated the service contract. Required, calculate amount to be recognized as expense. Recognized means recorded as expense during the vesting period. So in this kind of sum, there is no need to prepare a big table like what we prepared in the previous sum. Simple calculation, what you can make is, how many employees were there? It says options, it says 460, right friends? 120 and 460 employees. So my total options, what I am expecting is 460 employees, per employee 120 options. So in all, our company is expecting 55,200. We are offering to them, but 25% lapses. That means our expenditure will be remaining 75%. So 55,200, 75%, and multiplied by what is our expenditure? 12. You do this calculation, your total expense comes to 496,800. This 496,800, question says the vesting period is minimum 3 years. So 496,800 is to be spreaded over a period of 3 years. I can say therefore my annual expense to be debited to P&L account will be how much? 4,96,800 divided by 3. So my annual expense to be debited every year will be 165,600. First year also 165,600, second year also 165,600, and third year also 165. In this kind of sum, no need to prepare those big tables and no need to waste your time. Answer can come so easily. Nothing more difficult or typical to discuss about ESOP. As I told you, question number 6 of our textbook. And similar other 2 sums are there in our past paper section also. That also you can practice. Like see, if I just show it to you about our past paper section. In past paper section also you have 2 sums where you can practice, like question number 21 is there, which is a similar table preparation, and question 16. You can practice these 2 sums, question 16 and question 21, similar to that big table. Grasp it, get a mastery over it. I repeat, once you make the table perfect, the solution is there in your pocket. You are a master of that chapter. So do practice on that particular working. One sum I discussed, choice limited. Other 2 sums I'd shown you, numbers 16 and 21. And in my opinion, that will be enough for you for ESOP. That completes our discussion for ESOP. Thank you.